Let's bring in Greg Melich of ISI, and we'll talk to him about the retail space. Of course, he works with Ed Hyman and Nancy Lazar, covering the equities. How do you dovetail in the economic factory that ISI is with your you got to wake up happy that you got this team working behind you.
A bit like a kid in a candy store, frankly. I mean, macro is so important to retail that we think it helps us get an edge on what's really going to drive sales in 6 or 12 months' time, and that's critical to our stocks.
What's the Hyman Lazar call right now, macro?
Well,
where are they on GDP?
3% GDP, and I think what we've seen is some of the data suggests there's some bias to the upside, but the key is getting jobs going again. If we don't get jobs growth, that's really what gets you the follow-through.
This chart, I didn't believe when I made it. Per capita GDP growth plunges. Greg, look at it down here. This is per year, per person growth rate. And the blue above the yellow line is we feel pretty good. And it really hasn't been very good, has it? Where is this good consumption coming from if it's not coming from growing incomes?
Well, look, we dropped a lot. So a lot of it is just how much the spending came down. So where we think that next year, our lead indicators telling us retail sales will probably be up around 3.5%, with the bias towards 4%. But to get that, you do need unemployment to get down from the 9.7, 9.8 we're running. If we can get that down to under 9%, basically that's what could get retail sales really humming to 4.5 or better.
Okay.
And that's not our forecast yet, but that's the key thing to watch.
Okay, I want to do the number if we could right now. This is about wealth, and this is about the stock market making retail look good. This is fabulous. The number, 12 to 14%. Here it comes. Great view of the Empire State Building there. 12 to 14% increase in, quote, world wealth. I love that phrase, due to developed equities in M&A. Will Mott of Credit Suisse working with Neil Sauce on that. The stock market makes everybody feel better. How critical is a good stock market to good retail sales?
It's important. So if we look at our lead indicator model, it's jobs followed by net household worth, or basically driven by home prices, and the stock market could be a factor of that, and then fuel and energy costs. So those are the three key things. We led with jobs. I would also say if we could get the stock market to go, or home prices continue to stabilize, that'll be the other thing that could really bring retail back better than it has been.
Where does oil impinge? Is it 100? I mean, do you have a new number?
There is no magic number. Everyone wants a magic number. What we like to use is
we don't like magic numbers here at Surveillance Midday. We understand there's like a sport to this.
Because it's not just your gasoline, right? It's your home electric bill. It's all your general utilities. It's other things that could flow through in inflation into food costs that you were mentioning before. So what we track is fuel and utility CPI, and if that goes up, every 10% change in that takes about 120 bips off of retail sales demand. So if that does start to improve, that's probably our biggest worry looking out 12 months if that starts to go up.
The coolest thing of working with Greg Melich of ISI is I get to make cool charts. Here's a cool chart. Too much information. This is an original chart never before seen in mankind. Big box is cheap. I took the ratio of Tiffany's stock performance to Target's stock performance, and look at that spike up over there. That's Tiffany's doing better than Target. You say Target in the big box, they're a big value right now versus the high end that's done so well.
We not to pick on Tiffany's, but I would say the one thing, big picture in retail, that people have missed is that square footage growth 5 years ago was 2.5%. Now it's less than 0.5%. And as a result, some of our big box companies have cut their CapEx not by 20%, but in half or more. So the free cash flow that some of these companies, such as Target, is spinning out is 4 times what it was 4 or 5 years ago. So in the case of Target, the free cash flow yield now, it's down today because their December comp was a little light. The free cash flow is almost 9%.
Let me push back against this. They got the free cash flow. Are they going to deploy it to dividends and share buybacks? Or there's always over the horizon another country to waste money in? Are they getting responsible?
In the case of Target, absolutely. If you look at the last few quarters, they've used it. They've redeployed to buying back stock, about 5% of their stock over the last couple quarters, and a dividend yield that's around 1.7%. So we think most of that cash is coming back. CapEx has been staying down around $2 billion, maybe $2.5 billion, but it was $4 billion just a few years ago.
And then there's Office Depot. Okay, look at it here, folks. This chart, I looked at this and it looked like the Keefe Bruyette Bank Index. This is not a bank stock. That's a retailer. That's not Polo. That's not Target. I mean, that's not good performance. What did they get so wrong at Office Depot?
Well, fair disclosure, we did upgrade Office Depot from sell to hold a couple days ago.
I noticed that.
So we just don't think it's going to get any worse. But what they did wrong is they're just the number 3 player in an industry that probably doesn't need 3 players. And as a result, they're the least productive with the lowest return on capital. And we see them sort of slowly losing share to Staples and Office Max. That's just made it the tougher place to be. So if you want to play office products, we think either Staples or OfficeMax has more leverage and more upside.
And now we go to the land of the CFA. You just mentioned sell to a hold. The great belief on the street is a hold is a polite sell. At ISI, you've got to buy, a hold, and a sell. How do you define a hold? What is a hold?
Well, this is true actually from my prior career before I was at ISI. I've always felt you have to show some real dispersion. So, I mean, a hold for us
I thought at ISI
is a
people
hold.
were just hatched. They just only worked there. No.
I spent over a decade at Morgan Stanley, so to see Steve Roach's go is cute. So I guess the point is, we have a sell on Sears Holdings, we have a sell on O'Reilly Automotive, which is a very good company. We just think that it's widely held and there isn't much upside going forward. So if we think a stock is going to significantly underperform its peer group or the market, we'll put a sell on it.
What did all with your experience at Morgan Stanley, what did all the independent argument about analysis, what did that do? The Spitzer years back 5, 6, 7 years ago, how did that change security analysis?
Do we have an hour? Not really. So I think that
we have an hour. For Greg, we have an hour. I'd say, let Mark Crumpton know he can take the rest of the day off.
Look, I think the summary is analysts before Spitzer and after Spitzer, if you were really on top of your space, you didn't really get your research from trying to learn something that wasn't out there in the public domain. So, in the post-Spitzer world, it was really just about doing what you're doing, but just doing it faster and doing it better. So, if you really had a good view, strong view of your industry and understood your stocks, I think it actually, you could almost do better analysis, and it made that analysis more valuable.
One final chart: incomes go nowhere. You need incomes to do better, don't you? Will we see that in 2011?
Ultimately, we need to get income up, but the fact that we have started to see, again, that's where jobs is so critical. If you get some income growth, that's where we do think retail sales ultimately can grow 3.5% next year.
And this chart is per capita rather. This is inflation adjusted disposable personal income per capita, and you can see the little spike up with real low inflation. I think that's helping out. But look at that surge back in the boom of the 90s. We had 3 or 4 years there of just booming income growth.
And I think, look, there's an important factor to give. We're in a different world right now, so when we think longer term, we do think retail sales will probably trend at, say, 4% now, whereas back then, for the last 20 years, it was 5.5% growth. And a lot of that is that we do think the savings rate will, creep up or stay at a more elevated level. We think as people try to delever for the next few years, some of that income is going to be going into deleveraging, which is why we're not super bullish on top line.
10 seconds, single best buy right now.
I think Home Depot is actually very interesting, and I'll give you Target just because it's down 6% today.
It was a Ken Langone moment. Home Depot, the one to buy. Greg Melich of ISI, thank you so much.